All right, let's jump right in. We're going to jump right in. We're going to tap into a conversation that's been going on for over 200 years. But believe me, it's shaping everything about your life right now. Your job, how much is in your bank account, the whole global economy. We're going to meet four thinkers who didn't just have some big ideas about economics, they literally built the vocabulary we all use to debate it today. So let's get into it.
So, let's start with a big one, Adam Smith. I'm sure you've heard of the invisible hand, right? It's that classic idea that everyone acting in their own self-interest almost magically makes society better off, that greed is good, basically. But what if that's a massive oversimplification? What if we've got the father of economics all wrong, and he was actually talking about something way more complex, way more human?
Okay, so let's peel back the layers and get to the real Adam Smith. You see, before he wrote his most famous book, The Wealth of Nations, he wrote another absolute masterpiece called The Theory of Moral Sentiments. And honestly, this is where you find the key to his entire way of thinking. It changes everything.
So the view you hear a lot today, especially in Econ 101, is that we're all just these rational, self-centered machines, right? Just calculating what's best for number one. But Smith? Nah, that wasn't his view at all. He saw people as messy, complex, multifaceted beings. He argued we're driven by a whole range of what he called moral sentiments, things like sympathy for others, a sense of fairness, wanting to do the right thing. We're not robots, we're people.
So you might be asking, okay, if we have all these competing feelings, how do we manage them? Well, Smith had a really cool answer for this. He called it the impartial observer. The best way to think about it is like an internal referee, or that little voice in your head. It's your social conscience, constantly looking over your shoulder and asking, hey, how would this look to a neutral, fair-minded person? It's what keeps us in check.
And this, right here, is the crucial takeaway. For Adam Smith, the free market was never supposed to be some lawless, anything-goes jungle. He called it a system of regulated freedom. And get this, the invisible hand only really works, in his view, when we're all guided by that strong internal moral compass. It's not about unchecked selfishness. It's about our self-interest being balanced by our own sense of what's right. The whole system relies on us governing ourselves.
All right, so that's Smith's foundation. But it leads to the next big question in this great conversation. If the market is full of these complex, morally guided people, can it actually balance itself out in the long run? Or is it just naturally unstable, always lurching from one crisis to another?
Well, the first big, optimistic answer came from a French economist named Jean-Baptiste Say. His idea, known as Say's law, is actually pretty straightforward. He basically said that supply creates its own demand. Think about it. When a company produces something, it's also generating income. It's paying wages to workers, rent for its space, and making profits. That money is the exact amount needed to buy the very goods that were just made. So a massive glut of unsold stuff, according to Say, that's pretty much impossible. Okay, so fast forward a few decades, and another thinker, Leon Walras, comes along and gives this whole idea a serious mathematical upgrade. He envisioned the entire economy as one giant, incredible auction. Picture an imaginary auctioneer who's calling out prices for literally everything at once. Cars, coffee, your labor, everything. If too many people want coffee, the auctioneer raises the price. If there's too much coffee sitting around, the price drops. And this auctioneer just keeps tweaking all the prices until, magically, every single market is in perfect balance. That's his theory of general equilibrium.
So, we've got this beautiful model of a self-regulating market. But what happens when you take that idea and blow it up to a global scale? That brings us to the logic of free trade.
And no surprise, Adam Smith gets the first crack at this one too. His idea was called absolute advantage, and it's super intuitive. It goes like this. If one country is better at making wine and another is better at making cloth, it makes total sense for them to specialize and trade with each other. Easy, right? But here's the puzzle. What happens if one country is better at making both wine and cloth? Under Smith's original theory, well, no trade would happen. And that just doesn't seem right, does it? And this is where our next thinker, David Ricardo, comes in with an absolutely game-changing idea. It's called comparative advantage. Ricardo had this brilliant insight. It's not about who's the best at producing something in absolute terms. What really matters is the opportunity cost. In other words, what do you have to give up to make that thing? His big idea was that even if a country is better at producing everything, it still makes sense for it to specialize in what it's relatively best at and trade for everything else. This was a huge breakthrough. Let's look at the classic example to see how this works, because it's pretty cool.
Okay, so country A is better at making both cloth and wine. It's just more efficient across the board. But it's way more efficient at making cloth. Now look at country B. It's not as good at making either, but its disadvantage is smaller when it comes to making wine. So Ricardo's logic says, country A should go all in on making cloth. Country B should focus all its energy on making wine. Then they trade. And here's the magic. They both end up with more cloth and more wine than they could have possibly produced on their own. It's maybe the most powerful argument for global free trade ever made. But this picture of a perfectly balanced, harmonious world where everyone wins from trade, not everyone was buying it, not by a long shot. A powerful new voice was about to enter the great conversation, and he wasn't just going to question a few details. He was going to challenge the entire system, right down to its foundations.
And that voice, of course, belonged to Karl Marx. For Marx, economics was never about cooperation and harmony. It was about one thing: conflict. He looked at all of human history and saw a repeating pattern, a struggle between the people who do the labor and the people who own and control that labor. It didn't matter if it was a slave and a master or a serf and a lord. For Marx, the basic story was always one of exploitation.
Now, central to his whole critique is this idea he called surplus value. Let me break it down. Let's say a worker makes a product that's worth $200 in a single day, but their wage for that day is only, say, $100. So where does that other $100 go? That, to Marx, is surplus value. And he argued that this isn't some fair reward for the owner's risk or ingenuity. Nope, he saw it as the value of the worker's unpaid labor, and it was, in his view, the one and only source of all profit in capitalism.
So Marx described this whole process as the circuit of capital. It works like this. A capitalist starts with a pile of money. They use that money to buy commodities, things like raw materials, and crucially, a worker's labor time. Then they produce a new commodity, and they sell that for a bigger pile of money than what they started with. The entire point of the system, as Marx saw it, is just to make that pile of money grow. And that growth, that difference between the starting money and the ending money, that's the surplus value, pulled from the labor of the worker.
So there you have it. That intense critique from Marx really rounds out our four perspectives. We've got these four absolute giants of economic thought, and they've given us four totally, profoundly different ways to look at the world. The best way to think about it is like having four different pairs of glasses, or four lenses, that you can use to make sense of the economy that you see every day. First, you can put on the Adam Smith lens. When you look through it, you see an economy that isn't just about raw greed. Instead, you see it's made up of complex, moral people who are always trying to balance their own needs with a sense of empathy, all guided by that little voice of conscience inside. Next, you can try on the Walrus and Say lens. Through this one, the economy looks like a beautiful, elegant machine. It's almost like a perfect mathematical equation that's always, naturally, trying to find its own balance, a perfect equilibrium where supply and demand just click into place. Then there's the Ricardo lens. Put this one on, and you see a globalized world. National borders start to fade, and what you see instead is a system where everyone, every country, can become richer and more efficient just by focusing on what they're relatively good at in trading openly with everyone else. It's all about that powerful logic of comparative advantage. And finally, you have the Marx lens. When you look through this one, all the pleasantries of buying and selling just fall away. You look past the surface and see a system that's fundamentally built on conflict, a constant struggle between different classes over who gets to keep the value that's created by human labor. So this great conversation, it's still going on today, all around us. When you look at the world, when you see headlines about tech billionaires or arguments about global supply chains or fierce debates over the minimum wage, which of these lenses helps you make sense of it all? Which one, or maybe what combination of them, seems to explain the world you live in? Because the way you answer that question doesn't just shape how you see the economy, it shapes how you think we should change it.